Hello, everybody. It's your boy Tortoise Investing coming at you today with another one. Today, we're going to be taking a look at 5 dividend stocks that I'm looking to possibly add to the portfolio on Monday. So that's when my funds should hit my account, and I should be doing a buy on Monday. Monday is when I will do a portfolio update, show you what I bought and everything. So if you're new, make sure to hit that subscribe button and join the 365 that have already done so, and join me on this investing journey. Don't forget to like and comment. But yeah, these are 5 stonks that I am looking at. I would have bought this morning, but I didn't hit my trade window on M1, and yeah, my funds are still transferring over. But yeah, well, let's go ahead and take a look at everything here. We're going to be taking a look at Dollar General. I know. Taking a look at Kroger, Unilever, I don't know if I'm saying it right, Extra Space Storage, and Agree Realty. So with Dollar General, the thing that I've always been a fan of Dollar General. I go to Dollar General a lot, and it had a drop and a half yesterday, almost 20% in one day. It's up a little bit today. It's understandable. Yeah, they missed on their sale, and they lowered their guidance for the year. But I think this company is still going to be trucking right along for long term. I believe in them. They're still opening up stores like crazy. Their free cash flow yield is a little low at 0.96%, but I still like the company. Let's take a look at their financial sheet here. They got a dividend yield of 1.46%. That yield shot up. We got a payout ratio of 20.7%, so no danger there whatsoever. Dividend's still going to be raised. They have a revenue growth over the last 10 years of around 10%. Their free cash flow is what took a small hit, but you take this out, and everything is ticking in the right direction. It's going up. EPS over the last 3 years, 2 years has kind of not been growing as much, but over the last 5 years at a rate of 13.73%. Their dividend over the last 5 years has been increasing at a rate of 15.2%. Their last dividend increase was around 9%, I believe. This says 7, but 55 cents to 59 cents a share. They don't have a lot of debt, which is one thing I really like. Their debt is $5.7 billion. Their EBITDA is $4.05 billion, so there is no issue there whatsoever. They are buying back their shares. Their share count is decreasing very quickly. This might honestly be where some of the cash flow is going. But yeah, return on capital employed is around 13 to 15%. I like the company. I'm a big believer in what Warren Buffett says: be fearful when others are greedy, and be greedy when others are fearful. And this sold off like crazy yesterday. On Monday, I may be very, very greedy. I don't know. I might be greedy. I'm not sure yet. But let's take a look at Kroger. Kroger's another one I've been looking at. Is a free cash flow yield of 3.21%, dividend yield of 2.26%, and a payout ratio of 32.35%. They got some nice little revenue growth here, pretty consistent over the rate of 4.36% over the last 10 years. They have a pretty consistent free cash flow. It's not really growing or decreasing all that much. Same thing with their EPS. It's kind of leveled out over the last couple of years. They got some debt at $11.9 billion. Their EBITDA is $7.7 billion, so that's perfectly fine by me. That falls in line with my 3 times ratio. I don't like companies that have 3 times more debt than EBITDA. When it comes to their dividend, the thing I really, really like about it, over the last 5 years, increased at a rate of 15.7%. Oh my gosh. I love dividend growers, and this is very rapidly growing. They issued more shares this year. I don't know what that was about. They were buying them back slowly but surely. And the return on capital employed is growing. Since 2020, it has went from 7% to 12.5%. So I like Kroger. Kroger's another good one. Unilever, again, probably saying that wrong. They got a free cash flow yield of 4.828%, a dividend yield of 3.47%, and a payout ratio of 64.42%. This would be more of a safe dividend play more than anything. This is kind of like a Procter and Gamble in a way. Their revenue, pretty consistent, very slow growing. Their free cash flow, slowly ticking up, but just pretty consistent at overall. Over the last 5 years, even over the last 10 years, been increasing the EPS at a rate of 6.62%. Not bad. The dividend's kind of all over the place, but that's okay. It's a good company in my eyes. They got some debt, $21.4 billion. Their EBITDA is at $13.1 billion, so no issue there. And they are buying back shares slowly but surely. And return on capital employed is going up slowly but surely, which is very nice. They make a bunch of different things. As you can see here, they got the Ben & Jerry's ice cream, the Dove soap, Sunsilk, Olay. Just a couple of different like foods and like care products and stuff, But yeah, it's all reliable is what I would definitely say about that one. Old reliable. Another one that I really like is Extra Space Storage. This one is a REIT. Coming in at a free cash flow yield of 6.22%, dividend yield of 4.43%, and a payout ratio. We don't really pay too much attention to that because it is a REIT. Yeah. So revenue has been increasing at a rate of 11.73% over the last 5 years. Their free cash flow yield has been increasing at a rate of 15.57%. Delicious. I love growing free cash flow. Sorry. So their debt, REITs usually carry a lot of debt, which is fine. Their dividend has been increasing at a rate of 15.74% over the last 5 years. There are some instances where they increase it a little bit, and then there are some instances where they increase it a lot of bit. But it has been increasing. It's good. I think this one's off of its highs. Yeah, this one touched the 220s at one point, and it's down to 143. So this is another one that I really, really like. Agree Realty. It's very similar to Extra Space Storage. If I was honestly, I'd probably just choose Extra Space Storage over Agree Realty. Let's see here. Let's take a look at Williams-Sonoma instead. Haha. This is another one that's been on my watch list. Agree Realty. It's a monthly payer. It's nice, but like, I don't know. If I had to choose a REIT, I think I'd choose Extra Space Storage over that. So we'll go to another one that I really like, Williams-Sonoma. They got a free cash flow yield of 10.4%, a dividend yield of 3.17%, and a payout ratio of 21.37%. I'm half asleep, everybody. I made this list just looking off my Weeble watch list, and that's the reason I'm like, slightly all over the place. I'm sorry, but I'm trying to crank out this video before I gotta go to work. I gotta put in a 9-hour shift today, which is fun, but you gotta work to invest. So Williams-Sonoma revenue's been increasing at a rate of 10.3% over the last 5 years. EBITDA is also growing, very nice. Their free cash flow has been increasing over the last 5 years at a rate of 17.65%. Very, very nice. EPS has been increasing at a rate of 40.4. It's been going up quite a bit here recently. Over the last 10 years, a rate of 20%. Very nice. Very, very nice. They don't have any debt, which I love. I really, really like that. And the dividend yield has been increasing at a rate of 15.92% over the last 5 years and 11% over the last 10 years. So they have been actually increasing here as of late, that dividend percentage increase each year. And they've been buying back shares like crazy. Look at that. Bam. That right there is where that cash drop is from. They bought, what is it? Over 7 million of their own shares. So very nice. And their return on capital employed is ridiculous at 50%. So yeah. These are 5. Really, Agree Realty still on my radar. So 6 bonus stonks that I am looking to possibly add to my portfolio. I am really torn between three of these. I love Williams Sonoma, I love Extra Space, and I really like Dollar General, especially where everyone's afraid of it. Um, I don't know. Let me know what you think down below. Which one should I be checking out to add to the portfolio? That will be on Monday, so stay tuned for that. And until then, I hope everyone has a great weekend. See yous.